20 years of U.S. pairs trading, negative 0.50% compound annual growth rate, with a Sharpe ratio of negative 0.81, 6 years where the strategy held nothing at all. The S&P 500 ETF, SPY, returned about 10.3% annually over the same period. The strategy didn't blow up. It lost money slowly. What it did in 2008 and a handful of other years was stay flat while everything else fell apart. Here's exactly what happened. The backtest uses annual reconstitution over 20 years, 2005 through 2024, across U.S. stocks on the NYSE, NASDAQ, and AMEX. At the start of each year, the engine rebuilds the portfolio from scratch using only data available at that point. Same sector pairs with trailing 12-month correlation of at least 0.70 are selected and ranked. The spread is computed via an ordinary least squares hedge ratio. Only pairs where the absolute z-score exceeds 1.5 at formation and enter the portfolio. These are pairs where the spread has already diverged, so we're betting on convergence over the coming year. Entry and exit both use next day close or MOC execution. Signals from one day's closing data can't be acted on until the following session closes. No peeking at today's data and trading at today's price. Pairs are held for the full calendar year. Position sizing is equal dollar, market neutral, half long, half short. On average, 5.4 pairs were active when the strategy was invested. Some years had 7 active pairs. Others had 0. Over 20 years, the strategy returned negative 0.50% annually. SPY delivered about 10.3% over the same period. Sharpe ratio of negative 0.81. Maximum drawdown of 18.4%. Beta of just 0.07. Meaning the portfolio absorbed almost none of the equity market's risk premium. That's by design. Long-short pairs cancel out most market exposure. But it also means you don't capture the equity return. Here's the year-by-year breakdown. The strategy beat SPY in exactly 3 out of 20 years: 2008, 2018, and 2022. 20 years of data, 3 wins. The post-2012 bull run was particularly painful. Low volatility, high intra-sector correlation, spread compression. Signals rarely fired or fired and failed to converge. The worst absolute year was 2005 at negative 8.79%, driven by 7 active pairs that moved against positions and didn't recover within the holding window. The recent stretch from 2020 through 2024 tells the story. 2020 became a cash year under MOC execution. Only 2 pairs qualified and didn't meet the minimum pairs rule. 2023 returned 6.7%, and 2024 returned 2.7%, but SPY returned 26% and 25% in those same years. The strategy captured single-digit gains while leaving double digits on the table. 6 out of 20 years, the strategy held nothing. 0 qualifying pairs. 0 return. Those years: 2010, 2011, 2017, 2020, 2021, and 2022. In 2010 and 2011, the post-crisis recovery compressed cross-sector correlations so much that the pair selection filter found nothing usable. In 2010, only 1 pair met the correlation threshold, below the minimum pairs rule requiring at least 3 active positions. In 2011, same situation. SPY returned 14.3% and 2.5% in those years. The strategy earned nothing. In 2017, a strong low-volatility bull market created the same problem. Correlations rose across the board, reducing intersector spread dispersion. 0 pairs qualified while SPY returned 21.6%. 2020 is a new cash year under MOC execution. With same-day entry, 3 pairs qualified and returned 9.2%. With next-day close entry, only 2 pairs passed, falling below the minimum pairs threshold. The COVID crash in March compressed the entry window so tightly that waiting 1 extra day meant missing the trade entirely. That's a concrete example of how realistic execution assumptions change results. 2021 and 2022 tell the most interesting story. Back-to-back cash years in completely opposite markets. In 2021, the meme stock era pushed idiosyncratic volatility so high that pairs which historically correlated at 0.75 or better were behaving randomly. No qualifying pairs while SPY gained 31.3%. In 2022, the opposite happened. A rate-driven sell-off hit every sector simultaneously. Cross-sector correlations spiked because everything fell together. And again, no pairs met the threshold. SPY fell 19%, exactly the kind of year where a market-neutral strategy should earn its keep. It contributed nothing. Cash yields aren't just missed returns. They represent capital sitting idle earning zero yield. At roughly 2% average short-term rates over the period, 6 cash years represent about 12% in foregone risk-free returns. That's a hidden drag that doesn't show in the headline compound annual growth rate. Here are the most notable years, the highs and the lows. The strategy beat SPY in only 3 years, 2008, 2018, and 2022. 2008 is the textbook case. SPY dropped 34.3% as the financial system nearly collapsed. The pair's portfolio lost 2.5%. That's 31.8 percentage points of excess return in a single year. The market-neutral construction means equity beta was near zero. Sector pairs that had historically co-moved continued to co-move in the chaos just at lower levels. The short legs hedged the long legs even as both fell. That's the theory working exactly as advertised. 2018 was smaller. SPY fell 5.2% driven by trade war fears and Fed rate hikes. The strategy lost 0.5%. Not profitable, but less bad. 7 active pairs that year provided enough diversification to absorb sector-specific shocks. 2022 is a technicality. The strategy was in cash, not because it predicted the downturn, but because no pairs qualified. Earning nothing during a 19% decline looks fine on paper. But in a year with 4% short-term rates, zero return is actually a cost. The pattern across all 20 years is clear. Pairs trading offers crisis defense through genuine market neutrality. A beta of 0.07 over 2 decades isn't luck. It's the structural result of holding offsetting positions. But crisis years are rare. The protection costs you every other year, and even in 2008, the best year by far, the absolute return was still negative. The backtest doesn't capture everything. Short-selling constraints are the biggest gap. Not every stock is shortable at all times. During crises, exactly when the strategy should perform best, borrow rates spike and some stocks become unavailable. The backtest assumes frictionless shorts, which may overstate performance during the periods that matter most. The correlation filter is backward-looking. Pairs that look correlated over the trailing 12 months often diverge in the trading window. 2 stocks that move together for 5 years can decouple permanently when one changes its business model or faces a regulatory event. That's the core risk in any statistical arbitrage strategy. There's also the benchmarking question. SPY isn't really the right comparison for a market-neutral strategy. These strategies target T-bill returns plus alpha against short-term rates of roughly 2% annualized over 2005 through 2024. A negative 0.50% compound annual growth rate underperforms by about 2.5 percentage points per year. Worse than the old same-day entry results suggested, because MOC execution removes the implicit look-ahead bias. Du and Pfaff documented in 2010 and 2012 that pairs trading profits collapsed after the strategy was widely published. Our 20 years of data is consistent with their findings. Parameter sensitivity matters too. A different correlation threshold, Z-score entry level, or minimum pair count would produce different results. We ran one configuration. The space of possible configurations is enormous. That's what 20 years of U.S. pairs trading data shows. The full results, year-by-year breakdown, and a live pairs screen are on the blog at cetaresearch.com. Link in the description. The backtest code is open source at github.com/Ceta Research/backtests. Run it yourself with different parameters. Subscribe for more backtested strategies every week.